This LOS is evaluate a company's past financial performance and explain how a company's strategy is reflected in past financial performance. Little introduction with regards to this reading that we're looking at the LOS for. This reading presents several important applications of financial statement analysis. Among the issues that we'll address are the following. What are the key questions to address in evaluating a company's past financial performance? How can an analyst approach forecasting using a company's future net income and cash flow? How can financial statement analysis be used to evaluate the credit quality of a potential fixed income investment? How can financial statement analysis be used to screen for potential equity investments? And how can differences in accounting methods affect financial ratio comparisons between companies? And what are some adjustments analysts make to reported financials to facilitate comparability among companies? Application: evaluating past financial performance. Some of the questions that we look at are: 1. How and why have corporate measures of profitability, efficiency, liquidity, and solvency changed over the periods being analyzed? 2. How do the level and trend in a company's profitability, efficiency, liquidity, and solvency compare with the corresponding results of other companies in the same industry? What factors explain any differences? 3. What aspects of performance are critical for a company to successfully compete in its industry, and how did the company perform relative to those critical performance aspects? And finally, what are the company's business model and strategy, and how do they influence the company's performance as reflected in, for example, its sales growth, efficiency, and profitability? Evaluating a company's historical performance addresses not only what happened, but also the causes behind the company's performance and how the performance reflects the company's strategy. So on the previous slide, we saw a number of questions, and data available to answer these questions include the company's and its competitors' financial statements, materials from the company's investor relations department, corporate press releases, and non-financial statement regulatory filings such as proxies. Useful data also include industry information from industry surveys, trade publications, and government sources, consumer information from customer satisfaction surveys, and information that is gathered by the analyst firsthand through on-site visits. Processing the data typically involves creating common-size financial statements, calculating financial ratios, and reviewing or calculating industry-specific measures. Quick little practice question. In a comprehensive financial analysis, financial statements should be A, used as reported without adjustment, B, adjusted after completing ratio analysis, or C, adjusted for differences in accounting standards such as International Financial Reporting Standards and U.S. Generally Accepted Accounting Principles. C is correct. Financial statements should be adjusted for differences in accounting standards as well as accounting and operating choices. These adjustments should be made prior to common size and ratio analysis. Because this reading is application, it's bringing back some of the calculations that we had to do in previous LOS. So I put this question in as a nice little review. An analyst gathered the following data for a company in millions. Gross investment in fixed assets, December 31st, 2000, 2.8 million. December 31st, 2001, 2.8 million. Accumulated depreciation, 1.2 million in 31st December 2000, but 1.6 million in 31st December 2001. The average age and average depreciable life of the company's fixed assets at the end of 2001 are closest to A, average age 1.75 years, average depreciable life 7 years, B, average age 1.75 years, average depreciable life 14 years, or C, average age 4 years, average depreciable life 7 years. Nice little question to check our memory because we have seen this before. So C is correct. The company made no additions or deletions from fixed assets, so you can see the gross investment was the same, and the accumulated depreciation went up by 400,000. So we know debit depreciation expense 0.4, credit accumulated depreciation 0.4. So we went from 1.2 to 1.6 million. So we have to remember, what is the calculation for average age? It's accumulated depreciation divided by that depreciation expense. So 1.6 divided by 0.4 equals 4 years, okay? So C has to be correct because it's the only one that has 4 years. It's not 1.75, it's not 1.75. But just to finish it off, average depreciable life is equal to the gross investment, the 2.8, divided by the depreciation expense. So again, 2.8 divided by 0.4, and that's going to equal 7 years. Okay, so C is correct. Nice little question. And that's the last slide for this LOS. Thank you.